Hello, Bill and Brian here with a weekly update with Energy Road. Listen, we are looking forward to talking to you today about difference between diesel and gasoline and what the heck is going on. So, Brian, why don't you lead us out?
I look like a banker in this.
Oh,
Yeah.
yeah, you do look like a banker.
It's baseball season. So listen, folks, thanks so much for joining us. We're going to talk a little bit about diesel and gasoline, and this is a topic that came up within our customer base, and it really came down to looking at diesel versus regular in the United States. So when we look at diesel prices versus regular prices, these things are indications of particular things in the economy, particular things on refining, and it impacts supply demand on the crude oil side, supply demand on diesel, supply demand on regular. So we wanted to come up with kind of a presentation about diesel versus regular, why it matters, why diesel, is it worth more than gasoline? And really this question came up because, Bill, didn't you see that they were the same exact price recently?
Yes, at a convenience store I was looking at, I saw diesel and E10 unleaded selling for the same price, and that price was $3.17 was cheaper. Doesn't happen often. I've been noticing that it's not quite. It looks like there's still only about a 30-cent differential right now in some of the other stations. But when I saw that,
Wait a minute.
exactly. So we're going to talk a little bit today about what the heck is going on. So Brian, you're going to talk a little bit about the 3-2-1 crack spread. You're going to talk a little bit about where the stocks are. So, let's get this thing going.
Forget about the curveball, Ricky. Give him a heater.
All right. So listen, what are the main consumption markets for diesel and gasoline? Diesel, think of transportation, buses, trains, industrial construction equipment, and countries that consume large amounts of diesel are in China, the European Union, and got to say that 10 times fast. European Union. Say that 10 times fast. That's a hard one. European Union.
You're talking about the European onion?
Yeah, exactly.
The European
Exactly.
onion.
The U.S. So I classify, this is my personal definition, as diesel being the big moving parts of the economy. These are moving ships. These are moving construction equipments. This is the big dollars behind the energy industry, or behind the economy, really. And then you look at gasoline. Gasoline is really going to be U.S. passenger cars, light duty, individual commuters, and this is quote unquote the small economy, or the consumption economy. So you got to think about it this way, that if you buy something on Amazon, diesel is used getting anything from the raw materials to the final product to the big shipping on ships as well as trucks to get it to warehouses. And then from the warehouses, it transitions into more gasoline. And obviously, this is going to change with EVs, but that's when it kind of downgrades from a diesel to a gasoline price. And again, the reason we wanted to look at this is that when you look at diesel versus regular, there is usually a price spread. But we just noticed something interesting in the Midwest. Diesel is actually less than the 5-year average, and currently at only 17-cent spread. And then you look at the West Coast, and the West Coast diesel is actually less than gasoline. Think about that. Diesel in the West Coast is worth less than regular gasoline, and that's fascinating to me because that normally does not exist.
So, Brian, one of the things that we have to understand is that when you refine a barrel of oil, you do not get to choose what you want. So for
Right.
every barrel of oil, which is basically 42 gallons, for every 42 gallons, you get about 21 gallons, 20 to 21 gallons of gasoline and about 18 to 19 gallons of diesel. Every barrel. You have to do something with the commodities when you do that. So that's why you'll see this go up and down based on demand. If their demand is not in sync, you're going to see a lot of price differential.
Right. And this is this is obviously going to be very dependent on what type of crude oil. But one thing that you look at with a barrel of crude oil is what the price layers or what content you're going to get out of it. And as Bill said, it's really ingrained in what type of crude oil it is. And some of these actually have, let me change this. Some of these actually have more gasoline. Say they have this amount of gasoline and then this amount of diesel and this amount of other products. So what typically happens in the refining industry is there's a spread that we're going to talk about that is the 3-2-1 crack spread. This is a commonly used metric for refining margins. And for anybody in the energy industry, you've heard of this crack spread, and it represents the theoretical gross margin for a typical refinery, taking 3 barrels of crude into 2 barrels of gasoline, 1 barrel of distillate, and the 1 barrel of distillate will likely contain some of these other products, but this gives us a very simple way of looking at the refining spread between crude oil and diesel and gasoline. Right, Bill?
Yes. And so the problem with the 2 barrels, once again, it goes back to what this is a typical Venezuelan barrel and not necessarily a Permian barrel. And so there's a difference in that you have to sort of be able to, the 3-2-1 crack spread was based off what we can refine in the U.S.
Yes. And so it is going to be highly dependent on what content, and this is where what type of crude oil is in there really determines the value of that crude oil. And honestly, it's one reason when you look at when we look at our crude oil dynamics, it's the reason we're exporting 4.7 million barrels a day and importing 6.6. So you could ask yourself, well, why are we exporting and why are we importing? It has to do with our refineries, the way they're tuned to particular barrels, and how those interact with one another. So we produce in the United States a lighter barrel, and those are exported out of the country, and we import a heavier barrel that has more of these heavier content, higher value fuels in them. You know, gasoline
So,
is going to be one of the cheaper components in there.
and to say this is really our newer barrels that are light. It's not some of our older barrels are still pretty heavy, but all the newer barrels you're seeing coming out of the Permian and out of some of the more shale, those are a lighter barrel.
Right. And that's part of the reason that when we look at the supply side of the equation, we look at where our barrels are coming from. And let me scroll this down. So when we look at Permian being a big portion of our production, 6 million barrels out of 13 million barrels a day, that is going to be light sweet. And then you have Niobrara and Eagleford that are going to have a little heavier content. Bakken is going to have a little heavier content, and Anadarko is going to be mixed. So those are kind of some geographic areas that we can dive into, but it really depends on what that well is, because again, it's not going to be a 2-dimensional view of where it is. It's a 3-dimensional based upon what zone they're drilling into. So it gets very entrenched. So we're going to try and keep this at a high level. But here's some products that are typical from a crude oil refinery: gasoline, diesel, jet, heating oil, and lubricants. Um, so the 3-2-1 crack spread is kind of a measure of the profitability of a refiner. It's what I call back of the envelope, because it is highly dependent on what crude is going into the refinery, what products are coming out. And let me pause and say, listen, folks, if you have questions along the way, this is kind of a tutorial, and we're going to talk a little bit about the market a little bit later. But if you have questions along the way, feel free to type them out, and we will get to them live. So when you look at a distillation of crude oil, what is distillation, Bill? He can't talk. He's on mute. So distillation is going to be part of the refining process that extracts, because when you start with a barrel of crude oil, this is supposed to be a barrel right there.
So first of all,
There
it comes from heating it first. You have to just remember, gas, when you get products, you make it cold. Oil, when you get products, you heat it. So that's the two basic ways you go. So as you heat it, different products come off in the tower and based at different temperatures, and you get different products.
Right.
And so that's what you do. And the one thing to remember, that the reason we had a 3-2-1 crack spread was we were a country that needed gasoline versus diesel. And we were exporting a lot of diesel to Europe because they ran most of their passenger cars on diesel versus gasoline. And so as our country began to grow, we moved more things to diesel because why? It was cheap at the time because we were getting rid of it. And now it's sort of it then it went through a period where it was bigger, and now it's becoming the parity. And so that's why we're seeing these prices jump around, I believe, is because of the diesel parity that's happening on. The other thing that diesel does, and Brian, you can speak to this probably better than I, is it is sort of the price of diesel is sort of a predictor of economy. And so because the more diesel we use, the better the economy's doing. The less diesel we use, the worse the economy's doing. So it's been used as a predictor of the economic profitability, or not necessarily profitability, but economic activity for a long time. I'm not sure that's still that way, but I think it is.
Well, I mean, let's just step back and think about, you have construction vehicles, you have ships, a lot of the big moving vehicles and engines for the economy are really driven by diesel. So if you have a slowdown or a drop in demand of diesel, that means that the bigger dollars that are being spent on projects, and bear in mind these projects might be anywhere from 50 million to $50 billion. So if you have a $50 billion project and now all of a sudden they're spending less and say 30 billion, well, part of that is going to be coming from jobs. So as the jobs reduce, there's going to be less dollars coming through in the economy because there's going to be less jobs out there. So
what you're saying is,
If you build it, he will come.
yes, but it's part of the reason that we watch the interrelationship, and part of the reason that we watch this interrelationship between gas and diesel, because it tells us different things on the economy. And a couple of things that are really interesting right now on the diesel market. Change this there. Right? And if you look at the shape of 2025, we kind of traveled down. Well, look at 2024. We are traveling up. Now, why could that be? It's likely because the implied value of heating oil is depressed right now. it should be up here. So I would argue that right now diesel demand is soft, which is leading to potential drops in the economy. And you can look that spread. I'm just going to look at the East Coast. Went from $1 in February down to 40 cents. So that has compressed 60%. So a 60% compression of that, which tells us that when we're looking at the big part of the economy, we're looking at the bigger dollars that are currently driving down. And that is going to likely impact what I call the small economy. Small economy, it still accounts for a lot, but the big dollars will drive how much dollars are coming into consumers. Did I say that right? Bill, did I say that right? Maybe. Maybe
Yes, you
not.
did.
Okay.
I am having a few technical difficulties, but I think it's an OE.
What's an OE?
That's an operator error.
So now we're going to get our hands dirty around the crack spread. So the variables needed, we need oil price, we need RBOB or gasoline price, and heating oil. So when we look at the crack spread, it's 3 barrels of oil. So then you multiply this times 3, and then we have equals 2 barrels of gasoline, which is going to be here, times 2. But you got to bear in
No,
mind
times
this
42.
is a,
But yeah, at time that's a gallon.
Yes, I was about to say that.
Yeah.
Times 42, because this is a gallon price. So heating oil or ultra low sulfur diesel and gasoline are trading in gallons, whereas crude is trading in barrels. So you have to multiply this times 2 times 40. I said 41, 42. There you go. Times 42.
Well, you're shorting the barrel. What kind of marketer are you?
Yeah. So that's the math needed. And this is kind of some detail. If you want this, reach out to us. There's information down below and connect, or just drop us a comment and I will send it to you. So this is the crack spread. You take 2 times gasoline price times 42, 1 times the diesel price times 42, minus 3 times the oil price, and you divide that number by 3. So this is what the diesel versus regular spread, but this is the crack spread right now. And we're going to look at some current markets. We've gone from highs in, let me see. Oh, I can't do that.
So Brian, why is this important? Why is the crack spread important? What does it tell you?
It tells us a couple things. Number one, what the refiner spread is. Number two, the higher that spread is, then the higher demand for diesel and gasoline there is relative to the supply and demand of crude oil. So it tells you 3 different things at once. It tells you the health of diesel and gasoline, as well as the health of crude oil. But you do have to go a little bit deeper to get into the underlying of each one, because each one has their own supply and demand dynamics.
So basically, if refineries are making good margins, they're going to run. If they're making bad margins, they're going to scale back as much, causing some demand in the market. So
yeah,
the way I understand that, then the refineries, that's why we can look at refineries when they talk about the what they call their turnaround time. They try to do that when refinery margins are the least affected.
right. So we're just going to go back in time and take a look at what some historical margins have been. And from 2017 all the way to 2021, we kind of stayed in this range of what is that, 24 down to 10. I'd probably say probably closer to 13. So probably about a $10 spread. But then what happened in 2022, everything expanded, and it had to do with increased demand, and this was our COVID catch-up year. So 2021, we were kind of recovering a little. 2022 was a kind of a catch-up year. So we're coming back off this catch-up year and really depressing down into a more historical normalization of that. So,
But right now we're still higher. We're still higher than pre-COVID.
Right. But when we look at East Coast diesel versus regular, we're at low levels. West Coast is actually negative. That's fascinating. And here's a history of East Coast diesel versus regular. And what you can see here is we spent most of our time around anywhere from 20 cents to 50 cents. And then 2022 put us back into a new stratosphere. But we're now back beneath this 50 cents. So this is a little bit about the crack spread. If you want this chart, if you want to learn a little bit more about it, you can drop us a like, drop us a comment, and let us know what you think. But we wanted to get this out there because as we're looking at diesel and gasoline, this gets back to what Bill was talking about. Diesel prices are currently depressed, which is an indication that we may have a slowing economy. And that's going to factor into OPEC plus decision this weekend. It's going to factor into the Fed rate cuts. It's also going to factor into what the economy is going to look like during the election season. So right now, understanding the 3-2-1 crack spread, understanding the gasoline market, the diesel market, all of this is super important right now. And a lot of people are focused on the summer driving season, but that is going to be on the gasoline demand, and that is more hitting more of the consumer base, and diesel is hitting more of the industrial base.
So it's not regular important; it's super important.
It's super important. It's
even in the future, nothing works.
What's
not
that?
Your general important, not your regular importance. It's super important. So
it's
you
super
need your stuff super important as opposed to regular important.
It's super important. So as we just covered, I know a few people just joined us, so we're going to stay on a little bit longer. We're gonna stay on for about 7 more minutes. So if you got questions, drop us a comment, and we should be able to see it. But diesel impacts the big economy, gasoline the small economy, meaning the consumers, and the 3-2-1 crack spread. The three variables that we need are the oil price, the motor gasoline price, the heating oil price, and this is the formula for the 3-2-1 crack spread, which is 2 times the gasoline price times 42 plus 1 times the diesel price times 42 minus 3 times the oil price, all of that divided by 3, and that gets us to our current state, which, let me get back here, is yesterday. Let's actually look. This is actually a daily model that we have here. You can see just since April, we've gone from $29 down to $24. That's a massive refining compression. So as we're entering into peak refining, let's actually see how much we're refining right now on the crude oil demand side. And we are, that's the stocks. Yeah, we are currently at the highs. So we're approaching the highs. We could probably use 16.8 in 2023. Did we have refinery retirements?
Yeah, we've had one. I think we've had one go down since then.
Do you remember how much it was?
I can't remember if it was a 500,000 barrel or a million barrels. I think it might have been a couple. I think it was 500,000 in 2022 and 500,000 in 2023.
Okay, that
Roughly.
tracks because we had kind of a peak in 2023, 16.8, and we're at 16.48. So we are entering the period of time that between now and September that we're going to refine everything we possibly can. And so refinery inputs are at their highs. But one thing that that we're watching very closely is this down here, which is crude and products total stocks has started to tick up, which again gets back to, let me get back to this one, because this is the spread that we're watching that tells us the underlying health of the economy. And I don't think it looks very good, very promising. And when we look at diesel versus regular, that's showing that diesel prices are coming off, which means either we're oversupplied or people are starting to reduce their demand of diesel, which is going to impact big projects that is going to trickle down into the economy. So a lot of that is in contrast to OPEC plus. OPEC plus is calling for a very strong second half of the year to catch up with demand. And you got to bear in mind, OPEC plus is calling for 2.2 million barrels a day of demand growth, most of it in the second half of the year. IEA is calling for 1.4 million barrels of growth. And we're going to see who's right, but OPEC Plus is going to roll out their decision this week. But right now, diesel has given us a little indication that the economy might not be as well as people expect.
Oh, Rexy, I don't think this one's got the distance.
So, Brian, I was looking, I think I did see in the last deal that we had about 300,000 barrels go back into the SPR this last month.
Let's actually look. Storage stocks and okay, so we've been adding. Let me take off all this. We have been adding, and since we've been adding pretty consistently per week. About how many barrels is this? This is 368,000 barrels. We've been pretty consistent around this 300,000 barrels since, when did we start this? We started in December. So we've been consistently adding, but I would say that we're still on the historical lows. Again, let's
we're way on the historical lows. Yeah.
I mean, on the SPR, you can look at this. This chart actually starts in 1990. It was down in the, it was back in 1984, the last time it was this low. And, but what we typically watch for the health of oil, gas, and the economy is the crude and products total stocks. And we're starting to dip into the 5-year average. Let's take a look at the refined products side on the stock side. And if you have questions, drop us a line and ask. Motor gasoline has been, I don't want to say building because we're at the time that we draw. We're drawing less than we have in the past. Distillate, this is indicating what we were just looking at on the price side, which is we're slowly building or drawing less out than we have in the past. Jet stocks. This might be another indication. Jet stocks are way up, which might indicate that airlines aren't flying full capacity. Fuel oil is still on the lows. Other oils on the peaks, and fuel oil stocks are on the lows. So I would say when I look at heating oil and jet, both of those are a little concerning for the economy. But that's I
think the jet might have to do with the Boeing issue, and that they had a lot of planes down. A lot of times they weren't flying. actually flying at max capacity as far as the planes that were flying. They just weren't flying as many planes.
Then I traveled through the 7 levels of the candy cane forest and past a sea of swirly, twirly gumdrops.
We want to go that
was
way.
my trip yesterday. Yeah, that was my trip yesterday.
Bill was trying to single-handedly support the jet fuel market yesterday. So multiple airports, multiple flights, but he made it there okay. And I'd say yeah. So I think that is what we wanted to cover today. Again, if you want any of this information or you want to dive a little bit deeper, there's information down below. You can connect. You also can, I'm going to give you a quick commercial. You can also join our service for only $89 a month, have access to all our charts and weekly insights on crude oil, natural gas liquids, refined products, and electricity for only $89 a month. You get over 150 interactive downloadable charts that will help you find those answers quicker. For example, these charts are at your disposal and they are interactive and downloadable. So that is only $89 a month. And then if you want to go a step above, you can join Rogue Premium and actually interact with Bill and I once a month. We'll talk with you, plus have access to our private Discord channel. And then if you need custom support for your organization, we do have plans for that on Rogue Advantage. There are links down below. How'd I do? That was a minute. I was trying to make it 30 seconds. That was longer than 30 seconds, wasn't it?
Well, it was a Brian minute or a Brian 30 seconds. How's that?
So listen, would love
So
would
folks,
love to
what
have
we
you.
what we're saying is we'd love to talk to you, reach out to us, subscribe, and for sure be always thinking about how to do your business better. And if we can help you, that's what we want to do.
Right. And so listen, that's all we had. If you have any questions, if you have any comments, drop us a comment. If any of this was of value, drop us a like. If there was something lacking, if there's something different you want to know, drop us a comment and let us know, because all of that really, really helps. So listen, thank you so much. Really appreciate you coming and joining us and listening to us for 30 minutes. And we're going to try and do these every week, every Wednesday, and we will see you next Wednesday, right, Bill?
That's right. We'll see you next Wednesday.
All right. Thanks, folks. What do we do now?
Boy, some chicken wings had really hit the spot.